Let's discuss the regulatory framework of the BASEL Committee. It's a long discussion. We'll try to squeeze the discussion as concise as we can. I will first define the agenda, what we are going to discuss. We'll start our discussion with the steps that require to strengthen the global capital framework. We will see how to raise the quality, consistency, and the transparency of the capital base. We will see that how to enhance the risk coverage, supplement the risk-based capital requirement and its connection with leverage ratios. We will see the reducing polycyclicity and promoting counter-cyclical buffers. What is the minimum requirements, forward-looking provisions, and capital conservations. We'll see what is the excessive credit growth. And we will definitely look at addressing systematic risk and interconnectedness of these factors. Then we will extend our discussion. We'll go more in detail, introducing by discussing an introduction of the global liquidity standards. This is really important to have a global standard in order to have liquidity coverage ratio, net stable funding ratio, and monitoring funds and monitoring tools. These are really important. Then we will move forward to the transitional agreements between different stakeholders, and we'll see the scope of the applications of different kind of concepts. We will definitely discuss the minimum capital requirements and buffers that is created so often. We'll define the capital, what capital stands for, what are different categories, components of capital, element of capitals, and what is the limits and minimum and maximum. We'll definitely discuss the detailed proposal in terms of common equity, tier 1, additional tier 1 capital, tier 2 capital. Then we are going to discuss the minority interest. That is, of course, is an accounting term when you are holding a certain percentage with the non-controlling interest factors, regulatory adjustments, disclosure requirements, plus transitional agreements. These are really important to discuss, and we'll definitely discuss risk coverages, and we will see the counterparty credit risk. We will try to see the revised metrics to better address counterparty credit risk, credit evaluations, adjustments, and wrong way risk. Definitely asset value correlation, multiplier for the large institution artworks, collateralated counterparties, central counterparties, and enhanced counterparty credit risk. This will be our main area of discussion today. We'll definitely address reliance on external credit ratings and minimizing the cliff effect. What is cliff effect? This I will explain. Standardized inferred rating treatment for the long-term exposures, incentive to avoid getting exposure rated. We'll see how can we incorporate IOSCO codes of conduct that is fundamental for the credit rating agencies. We'll discuss the credit risk mitigation tools. This is our CRM, and unsolicited rating and recognition of ECAIs. We will definitely discuss capital conservation buffers, what are the best practices, what is the framework, what are the transitional arrangement. In terms of counter-cyclical buffers, we will see what is the concept, national buffer requirements. We'll definitely see the bank-specific counter-cyclical buffers. Definitely we will discuss the frequency and calculations, disclosure requirement, transitional agreements. In terms of leverage ratios, we will see what is the rational and what are the objective how we define what is the capital measure, what is exposure measure, what is transitional agreements and arrangements. All of this will be the discussion which will be going throughout the day. It will be a very interesting discussion, and we will keep ourselves involved into.